Intuit is another one of these large software companies that has just done so well over the last 5 years, but specifically the last 10. I mean, over the last 5 years, it's up 143%. But when you zoom out, since early 2015, late 2014, it's up from about 98. So now we're at 643. That's a large increase, completely blowing out the S&P 500. That's only gone up about 200% over the last decade. Intuit's just done very, very, very well. And like I said, they aren't the only one. There's quite a few. Adobe, CrowdStrike, Now, ServiceNow. There's so many of these companies that have just done super well. And part of the reason is if they just grow their customer base, they have such a high margin on their business that it's a lot of profit. And we can see, yes, it is an expensive stock. The PE is 62. Specifically, the forward PE is 33. That looks a lot better than 62. You're about double on normal PE, but when you look at forward PE, it's not quite as crazy. S&P 500 forward PE is about 24. We're at 33, just over 33. So you are definitely increased on it, but it's not quite double, right? You're not at what that would be 48. So you are expensive, but you're also, like I said, a company that is up 650% over the last decade. You're outperforming on the 5-year chart. You're dramatically outperforming the S&P 500 on the decade, the 10-year chart. And like I said, there's room for growth as well. I assume not everyone knows all the details of it, and we're not going to go through all their business today. But, they have quite a few things. Credit Karma, they have stuff for small businesses. They do a lot of tax stuff as well. Intuit TurboTax, I've used that before. It's pretty good software, so it's not perfect clearly, but this is a company that is well run. Like I said, a lot of them have really high margins, software companies, and I think Intuit's in that as well. And if we look at the growth, 21.5%, 17%, 14% expected for 2025. This is great numbers, right? Revenue, 13%, 12.5%. This is great. This is great stuff. And even AI could even make this a little bit better in the earnings per share, streamline a few things. You don't have a lot of, other than development costs, you don't have a bunch of, like, for example, Amazon. You're never going to have great margins on that. Walmart, Kroger, things like that. You're never going to have good margins, but the margins are just so good. And the more people you get, it's just constant money through. These are generally safe companies, unless they're super premium stuff, the software ones as well. So in a recession, yes, it's going to get hit hard because of the PE, but you should generally be fine. It's not like the underlying business is going to get absolutely walloped during a recession, unless it really hits the small business portion of it. Like I said, I think personally, I would not mind holding this stock long term at all. I don't, not because I dislike it, just there's only finite capital. But this is another software company that is just good. It's been dominant. It's great growth. As a long-term hold, I wouldn't mind holding it at all. Schwab thinks it's going to do well in the short term. They have it in the top 24% of stocks performing over the next year. Do I have it at that? Not necessarily. It's not because I dislike it, but there's only, I don't know. I'm not a 1-year outlook guy. I'm just not that smart. I can say, okay, this is a company that risk-reward ratio is right on it if you want a long-term growth-centric stock. I think this is a good long-term hold. Is it perfect? Probably not, but very unlikely you're just going to find the perfect stock, go all in on it. That's not how these things work. But Intuit, I would not be concerned about holding this long-term at all, at least personally. If we're looking at expensiveness of it, you're right in that range. It's actually usually been somewhere between 30 and 33.5. It was a little bit more at the beginning of 2024 at 38, but that forward PE is somewhere in that range. PE is a little bit different. You're actually kind of on the low end of that range as well, 62. It's somewhere around between 58 and 69. So you aren't buying at crazy expensive metrics either. And we're getting a little bit cheaper, but we've also run sideways for a while as well. So that shows growing business, which isn't surprising because we already looked at their earnings numbers and they were good. You're getting about 23 of 32, right? If I can do math right, yeah, 23 of 32 saying buy. That's pretty standard for a growth-centric company. You want about 2/3. You're right about in that range. Nothing too concerning there for analysts. So yeah, I think this is a great company. Clearly, they've derived a lot of profit. Stable business, long-term hold, wouldn't be concerned about at all. Is it screaming super cheap? Not really, but usually these growth companies aren't, because they have higher PEs and it's hard to know exactly what's cheap. But as long as they keep growing anywhere near the rate they are, this is a really solid company. And you should do well in the long term. But anyways, I appreciate you all for watching. If you enjoyed, like and subscribe. I do daily stock content on this channel. I appreciate all of you for watching.